Now we'll be discussing the second company, that is Enron Corporation. The company was an energy trading company and it was mainly into utilities, and it was based out of Texas in the US. We can see here in the chart that the company grew to a revenue of $100 billion. That was year-on-year growth from 1999 to 2000 of almost 100%. That's a very big number, as you can see on the chart. At the very same time, the stock performance of the company from the early 1990s till the 1998 year, the company kept on performing really well. The stock outperformed the general market. Goes without saying, at that point in time, the markets were also doing well because of the dot-com bubble and everything. But the performance which this company particularly showed was very good. So now, one differentiating point about this company vis-a-vis what we discussed earlier was this company was really appreciated by a lot of outsiders. When I say outsiders, a lot of banks appreciated it in terms of the business that the company did. Magazines like Fortune magazine appreciated the company, and it said that it is one of the most innovative company the US has seen, and it awarded the company with this particular award for 6 consecutive years, and so on and so forth. And it kept on, and it became the seventh largest company on the Fortune 500 magazine. So all things were in favor of the company. The numbers, we can see the revenue numbers grew at a very fast pace. At the very same time, a lot of outside validation also is something that this particular company received. Ashapur Intimates, on the other hand, was a very small company, and it did not look out for a lot of outside validation, because that kind of market capitalization company is not in the eyes of a lot of big people. But to the extent to which this company grew, a lot of validation started to come in, a lot of eyeballs the company caught in. All right, so that is what something the company did. However, as the dot-com bubble burst, in 2000, 2001, this was also one of the company that came down crashing. But before that burst, a lot of investors were investing into the company, especially the investors who believed in momentum investing, and the whole idea of buying high and selling higher kept on applying to this particular company, and a lot of investors in US, outside US, started to invest in this company. However, once the the fall came in, people started to figure out why exactly what exactly is happening to this company and why the fall came out. So this is something that we need to understand, that during the bubble, when things were rising, the company was outperforming, it was doing really well. On the face of it, again, superficially, if we look at the financial statements, things were pretty rosy. But again, if even in the years of the late 1990s, if you would have read the financial statements very thoroughly, you would have figured out that you could have figured out that something could go wrong with this company at that point in time as well. So that is one thing that we need to understand, that irrespective of how the company is performing in terms of its stock price, there could be something that could go wrong with the company in terms of its financial statements. Before you make a decision, make sure you just do not go through the revenues and the profits of the company. You read these things as well. Let's come back to Enron, and while we're talking about it, the company filed for bankruptcy in December 2001, and things went completely wrong for the company. So there were 4 primary reasons, if we classify the reasons into what went wrong with the company, there were 4 main reasons why these things, unraveled or it came out. The first one was a lot of off-balance sheet items were there, and the company was participating in a lot of off-balance sheet items. So to discuss this, I think many people who have followed the 2008 financial crisis, they might know what off-balance sheet items are and how the entire concept of SPVs work, that is special purpose vehicles. So even Enron used the entire concept of SPVs to make things work, to make sure that people keep investing in it. So what exactly happened here was Enron created a lot of SPVs. Consider it as separate companies which are not being reflected in the results or in the financial statements of Enron itself. Alright, different companies, different special purpose vehicles, alright, made for a particular purpose, could be anything that the company wants to do. What exactly Enron did with this SPVs was they passed on the assets to these SPVs, and once the assets were there on the balance sheet of the SPV, they issued debt and equity in against those assets, and got money in the name of the SPV. So now what really happened was whatever issuance of debt or equity happened was happening in the name of SPV and not Enron per se.
अगर आप ये वीडियो देख रहे हो तो आप ज़रूर किसी कंपनी को पढ़ना और समझना चाहते होंगे, और अगर ये बात सच है तो मेरे पास आपके लिए एक गुड न्यूज़ है। एट अपसर्ज हमने एक कोर्स बनाया है विच इज़ अ कंप्लीट कोर्स ऑन फंडामेंटल एनालिसिस, जहाँ पे हम काफ़ी सारी इन डेप्थ टॉपिक्स डिस्कस करते हैं, जैसे फिनेंशियल स्टेटमेंट्स को कैसे पढ़ा जाए, वैल्यूएशन एनालिसिस क्या होता है और मल्टी बैगर स्टॉक्स को कैसे पिक कर सकते हैं। ये कोर्स हमने क्यूरेट किया है नमस्कार प्रसाद के साथ, जिनके YouTube पर 20 लाख से भी ज़्यादा सब्सक्राइबर्स हैं और उनके वीडियोस ऑन फंडामेंटल एनालिसिस बहुत ही ज़्यादा फेमस है। तो वीडियो पे वापस जाने से पहले जो लिंक डिस्क्रिप्शन में है उसे चेक ज़रूर कीजिएगा एंड डू एनरोल फॉर दिस कोर्स।
So the balance sheet of Enron was neat and clean. There was very less debt and all those things. But the balance sheet of SPV had those mortgages and all those things. Now, so back in 2000, it was not really compulsory to show all your consolidated results of your own company, of your SPVs, and together and combine and show it to the investors. People could, there were ways how people could hide their SPV functions and SPV balance sheets and simply show the neater and the cleaner balance sheet which the company was making for itself. So this was one of the things which the company was doing, and the SPVs were getting established as a separate legal entity, and whatever main functions or operations were being done in terms of businesses were happening here, but in terms of the financial aspect of it, borrowing money, lending money, which could have spoiled the balance sheet of Enron, was being done on SPV. This is something that we need to understand on a broader level, and in today's terms, this is not really possible because any regulatory, be it be in India or be it be in the US, they have made it mandatory for public companies at least to show the results of their SPVs and their subsidiaries in a consolidated way and present it to investors. So no company can play around with SPVs and then put across liabilities there and only keep assets here and all those things. That was possible before. Now it is not really possible. So that is one thing that we need to understand, that with this particular company, there were a lot of SPVs, and those SPVs were carrying out these transactions, and that was not getting reflected on the balance sheet of Enron. All right. So that was one very important thing. Now, the second practice which this company followed, which again led to the increase in their entire financial statements in a positive way, which in turn led to the increase in the share price of the company, was mark-to-market accounting. All right. So mark-to-market accounting is very interesting. So for banks and companies which are in the financial sector, they generally reflect the fair value of the assets and the liabilities in their balance sheet. All right. On the other hand, for companies that are into manufacturing and all those things, they keep the book value of the assets on their balance sheet. Now, say for example, banks are in the business of borrowing and lending money. So, in case if I'm lending money, whatever is the true value of the money that I have lent, all right, it might be the case that I might not receive that money, so I have to highlight that in my balance sheet. In case if I'm going to receive only partial payments from the money that I have lent, again that has to be reflected in the balance sheet of the bank. And it is mandatory for all banks and companies in the financial sector to basically have a fair value picture in their balance sheet. But that is not really the case. That should not be the case, for manufacturing companies, because they cannot on a continuous basis value their machines and see what exactly is the fair value of the machines. So they follow the book value method, where the machineries and all those items are basically reflected on their book value and not the fair value. But with Enron, what they did was they used the mark-to-market principle for putting across the value of their assets, and at the very same time, the liabilities were not inflated up to the extent to which the assets were inflated. So what this exactly did was, while they were adjusting the assets for its fair value, this increased the amount of money they were making from non-operational activity. All right, could be derivative contracts which they were dealing into. When they marked it positively, or when they marked it, or when they use the mark to market principle, automatically the increased value of the derivative contracts was reflected in the income statement in terms of revenue, and those things came out as profits, and the company share price grew because the revenues and the profits were growing. So this is something that we need to understand, that whenever a company has assets and the company marks to mark, and the company uses the principle of mark to market for putting across the true value of the assets, in that case we should also take into consideration whether the liabilities are also valued correctly or not. So simply putting across the value of the assets in a truer way might not give you a clear picture, and it might inflate the revenue numbers and the profit numbers of the company. So this is something that the company had done. And as you can see on your screen, from 1999 to 2000, there was a particular column in the current assets of the company which highlights the fact that they were using the marking to market principle to basically inflate the value of their assets and inflate the value of their income statement. The asset from the price risk management activities, basically this includes all the derivative contracts and all those things which the company was using. Now again, the company was into energy trading and all those things, so automatically they will use derivative contracts because that is a part of the business, but to highlight or to market in this way is something that is wrong. All right, so since they were doing it in this way, whatever forward contracts, swap contracts, or the energy contracts that they were making with third parties was getting reflected in fair value, and they showed it under current assets as asset from price risk management activities in the consolidated balance sheet, and this in turn inflated the entire balance sheet and the income statement of the company. Now, while all these things were happening on the balance sheet of the company, at the very same time, the SPVs, which could have bring in some negativity to the overall balance sheet and the income statement, was kept separate. Alright, so that was, all the factors that we are talking about, they played around simultaneously and not, individually. So that it worked. So the overall picture became even more rosy for investors and people who are simply investing for the first time, or maybe who had a very less experience in terms of investing. So this is how it worked out. And as I mentioned, once the numbers were reflected in the current assets, they got passed on to the income statement as well. All right, so this thing works in accounting. Whenever the asset value increases for any company, all right, they have to mark that asset value increase in their income statement as well. Now, say for example, you had a machinery of 100 rupees before last year, and that machinery value increased to 120 rupees. Though you're not in the business of trading machines and doing all those things, but that incremental value of that machinery from 100 to 120, that 20 rupees difference has to be shown in your income statement, otherwise things would not match. All right, so that is what was done before. That 20 rupees, whatever incremental value that was there in the assets, was getting reflected in the income statement of Enron. And here the assets were not machinery but the derivative contracts which I mentioned earlier. So this is how it worked out. You can see, the other revenue of the company, it was always on the higher side. They had $4,000 million in 1998, $5,338 million in 1999, and $7,232 million in 2000. So every year this number was going high, and this is not a good sign. Generally, whenever you read companies, make sure that the revenues which the company is generating, majority of it, at least 80 to 90% of it, is coming from their operational revenue and not from other revenue, because those are not good signs and those are clear-cut red flags. Say for example, if you're reading a company like Asian Paints, all right, ensure that the company is generating most of its sales from the products it sells or the services it gives, but not from other things. All right, so this is something that you need to understand, and you need to be wary from companies which are not which are reflecting a good part of its revenue into the other segment. It is a clear cut red flag for us to while we read financial statements. Now the third thing which the company did wrong was they had a lot of SPVs, lot of subsidiaries, lot of companies which was operating under the parent company. So they had a lot of inter-segment revenues. Basically, when I say inter-segment revenues, basically, say for example, there were 5 SPVs. So company A sold something to company B, company B sold something to company C, or SPVC, or SPVC sold something to SPVD. All right, this worked around and they kept on inflating the revenue. All right, company A sold it to company B for 120 rupees, company B sold it to company C for 140 rupees. And every time this transaction happened or this round of money happened, they kept on registering it as revenues, which is again a very bad sign and should not be the case. So always look around for companies which has a lesser number of SPVs under it or a lesser number of subsidiaries under it, because in that case you'll be able to read the company better. All right, one company, one parent company, one product, selling a company making revenue from that product, that is generally the companies that you would like to read more. And once you get a knack of it, maybe then you get to understand when a company has a lot of subsidiaries, how the things function. Whenever this inter-segment revenues are there, we need to understand that there could be some inflation of revenue that could possibly happen. And as we can see again from the three sectors that we're able to see: transportation, wholesale services, retail, energy, the company was showing good number of revenues in these three segments of $800 million, of $1,600 million, and $200 million. So that is something, again, a way of manipulating the income statement, way of manipulating the profitability of the company and showing bigger numbers, showing better pictures, so that the valuations in the stock market actually inflates and the promoters or the people who have the majority of the shares, they end up making money. Overall, there was a lot of accounting substance in the company, but economic substance was missing. So that is no company can survive for more than 4 years, 5 years if these things are there, and it's all a way to operate the stock price of the company and make money out of it, make money from the capital markets. But this does not really work in the long run. All right. And lastly, goes without saying, if these things were happening, the corporate governance that the company had was definitely poor. There were the board that was there, which was supposed to manage everything, was not very independent. All right. The majority of the board should be independent so that they are able to take good decisions. They are able to look at the management through a different lens and make sure that things work out smoothly in the company. So that was not the case here. So, but naturally, the compromise was made at the board of director level itself, and the board was not that very independent. Goes without saying, the audit committee or the people who are looking the financial statements on a daily basis know when certain things happen, or when such kind of things happen. So it cannot be said that the audit committee was unaware about it. They are 100% in most of the cases aware about things when the revenues are inflated in such a way. So that is something that we need to look upon, that who is the audit committee, who are the people who are auditing the company, who is the outside auditor, do they have a fair background, do they have any cases against them, and all those things. All right, that is again very important. And lastly is the uh, transparency which the company followed while they were speaking to their investors or while they were speaking to their shareholders. Again, not talking about the SPVs, about the loans that they had taken on the balance sheet of SPVs, were all red flags. And when we figure those things out while reading the financial statements, and those financial statements say something else compared to what the promoters of the company are saying, again we need to look more deeply. And everything that increases at such a fast pace, we need to be very cautious in those cases. As a result to this, obviously, the regulatory came up with an act in 2002, which made it mandatory for companies to consolidate the results of their SPVs and present it in one go. So that was one of the key highlight of this particular scam that had happened back then. So I'll just help you with some of the provisions that came through this act in the US in 2002. So they developed an entire public company accounting oversight board, PCAOB, but it went through that name. They ensured that the auditors got more independence and they were able to reduce the conflict of interest between the auditor and the management. So that was the second. And they ensured that more financial reporting could happen independently. So that was one of the most important thing that came out. And at the very same time, the norms that were coming out were more stricter in terms of accounting sense, and they tried their best to make sure that in accounting sense they cannot manipulate numbers and then present it to investors, at least the publicly listed companies, because a lot of retailers money gets into that. All right, so no exchange, no regulatory would want to harm the money of the retailers, because once they lose trust in the stock markets or in the capital markets, it will be very difficult for the regulators to gain back that trust. How we saw it during the 1991 scam in India, because after that it took a good amount of time for markets to come back to its original value. People took a decent amount of time to really participate back in the markets, and all those things happened. So that was the broader idea, and at the very same time this act made sure that the employees were protected and there was no misconduct happening in terms of putting across the financial statements that the company was supposed to put across. So this is how exactly things worked around. These two case studies, I'm pretty sure, it would help you understand why reading between the lines is important, and why reading while digging deep in the financial statements is even more important for companies which are showing very good movement in the share price. All right, because growing for a company to grow 4x, 5x, 6x without tailwinds is very difficult. And if it is happening, why is it happening is something that you should question, and the answers you'll get it from the financial statements, in case if there's any fraud or there's any malpractices that the company has been following. So with this we end these two case studies, and we'll be discussing more about making income statements, how balance sheets are made, how cash flow statements are made, and how do we analyze them. And after that we'll talk about few ratio analysis, and we'll be pretty sure in terms of knowing how financial analysis is being done on companies. Thank you.